Speaking of markets, doesn't get more crazy than this. The news flow is awesome. The headlines and just crazy and out there. And the fact that they go viral so quickly through social media and platforms. I'm in the days where, man, you got to call long distance, international, speak to clients. Now they can get information in seconds through the internet. The news flow and the headlines, aggressive. Pretty nuts out there. Combine that with the hundreds of billions of active money being managed by firms using algorithms. And you know what you get? A shitload of volatility. Well, starting with the news flow, which is all negative these days, which helped push the markets down around 5% off its highs in the past few weeks. We're talking potential new tariffs from Trump, which kind of surprised the market. The trade war with China escalates. Massive slowdown we're seeing in global economies where central banks for almost every developed emerging market aggressively lowering rates right now. These rate cuts are supposed to help stimulate the economies, which is done in the past most of the time. But it's also resulting in negative yields where $15 trillion in government bonds have negative yields. What does that mean? It means the governments are actually getting paid to borrow money. It's crazy when you think about it. We have major protests in Hong Kong where the local airport has been shut down for days due to massive protests. It's not good for China, which China is kind of the world's growth market, at least biggest growth market. Hasn't been the last year with this tariff nonsense, a year and a half. But China is known for being the big growth market of the world. We have a negative yield curve, which means short-term treasury yields are trading higher than long-term treasury yields, which doesn't make sense. It's not supposed to happen. Essentially, the 10-year was trading at 1.62%, which is below the 2-year treasury note, which is yielding 1.63% as of today. And then you have all this historic stuff that they're going to throw in there. Last time this part of the yield curve inverted was December 2005, and that was about 2 years before we had the financial crisis. But it's a lot different. I mean, the credit crisis was caused not by subprime loans. It was caused by leverage. People think subprime wasn't that big of a deal. But when you're leveraging and creating synthetic CDOs off of these, off of real estate and pretending that they're all safe, I mean, that's what really, nobody knew how much leverage was in the market. But if there was no leverage and just subprime, the market wouldn't get hit that much. Massive amount of leverage. You only need housing to go down 4 or 5% before you see massive defaults. But it is a fact. The last time this part of the yield curve inverted was, about 2 years before the financial crisis. And also, when you look at research, I think Credit Suisse came out with a report, which is pretty good. It said a recession occurs on average about 22 months after this type of inversion. So what does that lead to? Recession headlines everywhere, going crazy. You know what? That makes sense. It's an indicator you should pay attention to, not the sole indicator, but for me, maybe one of 20 I look at, and I have to say, most are not signaling a recession. In the U.S., we could have one. We could look at the data. That could change in a month from now. We see massive declines in consumer spending, and the housing market takes a turn for the worse, which should be doing much, much better if the banks allow you to refinance because interest rates are, mortgage rates are near record lows, which should spur house buying. But affordability issues there. So, we'll monitor it over the next few months. But right now, the U.S., you look at stocks, they're not expensive. Stock trading at 16 times forward earnings, which is below around the 16.34 times average of the last 5 years. So we're not, if we fall another 10, 15% from here, it's going to create amazing buying opportunities. You see a lot of money flow into this market. But when you're seeing all this take place today, it's creating unbelievable volatility. Unbelievable. I don't know if anyone's really talking about this much. From my perspective as someone that covers thousands of stocks, right? Over just familiar with these names, love to I'm not recommending 1,000 stocks. We probably have around 20 in each portfolio, 15, 20 in newsletters. But I love researching stocks. I love listening to conference calls. I love earnings seasons. It leads to tons of ideas to me, listening to what these guys are saying. And the volatility I'm seeing today, I've never seen in my 25-year career. Not even close. I mean, take Yamana Gold for one. This is a mid-tier gold producer that was recommended in our All-Star portfolio. This is November 2018, so roughly 9-10 months ago. So during this time, we watched the stock right out of the gate go up 20%. Then it fell down 10%. It was up 15%. Then it fell down again. And now it's up more than 50% for us. Now, I'm highlighting this stock because in all-star portfolio, we usually have tight stops, right? Because we want to limit our losses. This is a trading newsletter where we have a brand new stock pick every single week. Most of those come from our guests, which I interview on this podcast. It's really awesome, getting lots of great ideas and just vetting those ideas, seeing which ones we like the most and putting them out there for you. That newsletter's doing well, getting lots of subscriptions to it. It's pretty cool. Original, you won't see anyplace else, but we had a tight 15% stop on this name, which we came a few pennies from stopping out, and we used a closing price. So a few pennies from stopping out, and then next thing you know, we're up, 55, close to 60% on the stock. And this is just one example. And this is gold. This is an industry that's gotten crushed. Yeah, it's been volatile. It's been going down for so many years. Now you're finally seeing, gold become a safe haven, and people are rushing into it, which makes sense here. But this isn't just the amount of gold. And when you're looking at stops, I've encouraged using stops. I always suggest using stops because they limit your risk. It's not a perfect system, but it does protect you from huge losses. You want to maintain your capital, especially in a market like this. Say if it goes down another 10%. Yeah, you're going to stop out, you're going to have some losses, but you have cash, right? You have cash now. And say the market continues to fall and falls even further. Now you have cash, which is what the greatest investors do, is they want to get in when prices are lower during extreme times. Again, it's not a perfect system, but it does work. But if you're using, say, 20% stop losses, which is common, some people use 25%. We use anywhere from 25 to 35. 35 we would use for Curzio venture opportunities because, again, it's so volatile that if we use 20% stops in that newsletter, you get stopped out before your thesis even, comes to fruition for all the growth catalysts you highlight, all that stuff. But if you're using 20% stops, which is around a good number, I'd say on average, that people use, and traders, it would be a little bit lower than that. Again, for more aggressive buy and hold, it would be a little bit higher. Large caps is around 20-25%. Then you probably stopped out at tons of stocks in your portfolio. There's more than 20% of the Russell 3000, not the Russell 2000, Russell 3000, all those stocks have fallen more than 20% over the past 3 months. It's crazy. You throw in the other risks like Brexit, further deterioration in European economies, just seeing it, it's crazy out there. North Korea, Middle East tensions, record high deficits. I have to tell you, it's tough to buy and hold stocks right now. And take the average retiree who usually doesn't look at their monthly statements. And I know this because I'm getting calls from family members that are looking at their monthly statements. You're supposed to be in conservative stocks, every couple months, maybe you look every quarter or whatever. But now your monthly statements, there's so much volatility. And you're looking at the fluctuation in the total value of their retirement accounts could be more than 5% every month, which is huge. And this creates a lot of nervousness. And again, I get it. I understand. When you talk about people with little working power, want to make sure that money is safe, secure. And what does that lead to? Well, that's the reason why you're seeing safe haven assets like gold, Bitcoin, treasuries, with near record low yields are seeing massive inflows right now. Now, I wish I could say this is temporary, but it's not. This is going to be the norm going forward. There's huge volatility, and you're even seeing it in some of the biggest names, the brand names out there. And if you're looking at algorithms in this trading system, they don't care how much a company earns, how much they generate in sales. They don't care who the CEO is or what technologies, innovations, or growth the company will see over X amount of years. No, they're looking at patterns, able to see a lot of the orders being placed or limit orders up front, being able to capitalize on these trends in milliseconds. That's why you see companies during earnings season, right? The ones that miss, you'll see, down 5-7% on the average miss. And they'll trade down 5 to 7% for the first couple of hours. Next thing you look at the end of the day, they're down 20%. They're down 20%. 20%. That's how fast these funds are running out. Boom, I'm out, I'm in, getting in, out, in, out. Don't look at the conference calls. Don't look at anything. Just looking at trading patterns. You see the same companies who beat during earnings season, where the stock will be up like 5%, only to close 15% higher by the close. People say, well, that's the shorts covering. Well, a lot of those stocks don't have massive short positions. I'm not talking about the Teslas and Netflixes and stuff like that, but just, average stocks or less than 5% of the float being shorted. Believe me, those moves are not being created. There's just a lot of buying coming in because the patterns suggest, hey, we can make 3% on this, just on this stock. And that's huge on these trades. And now with so much liquidity out there with these large cap stocks. I mean, look, we have a couple of stocks trading close to, $1 trillion valuations, Microsoft, Amazon. I mean, hundreds of billions could flow in and out of that stock in seconds, and you're not really going to see it too much. You would, but, 100 billion or a little bit more than that, but you get my drift. Like I said, this is going to be the norm going forward, which means there's going to be a lot of tailwinds behind gold, Bitcoin. I'm not going to argue which is better or worse. For some reason, people who buy gold hate Bitcoin, and people that buy Bitcoin hate gold. You're allowed to own them both, guys. It's not either or. I love the fact that the gold guys have no idea what they're talking about when it comes to Bitcoin, and the Bitcoin guys have no idea what to talk about when it comes to gold, but they just hate each other for some reason. I'm invested in both asset classes. Again, not here to argue which is better or worse. You could do a Google search and find millions of great posts of people that are just out there. But you look at that, gold is up nicely on the year, as well as Bitcoin, which is up around 200% this year. Again, treasuries as well. People look for safe havens. So in this podcast, I want it to be special because about gold, about Bitcoin. Yes, institutional money flowing to treasury, even into negative yielding bonds, which is insane in some cases. But I wanted to go over a few more safe havens that I think are going to be better alternatives. Again, I'm invested in gold, I'm invested in Bitcoin, but better alternatives than those two, and especially better than treasuries. So one of them is the security token industry. You guys know I'm familiar with this, where lots of new digital securities are providing investors with above average yields. You start to see a lot of these things come out. I'm seeing them across my plate. They're going to come out a lot more over the next year, 2 years, 5 years. But that's a huge appealing point for so many people where they're dying for yields. And you're seeing, based on tokenizing real estate, that they're offering higher yields. Looking at some of the biggest bond people looking to get into this industry. A close friend of mine as well. Not that it's a perfect safe haven that you can keep your money there, but it is an alternative. It's an alternative. And that's why Bitcoin is so valuable. People don't talk about why Bitcoin is so valuable because it's not linked to any other asset. If you look at the markets today, everything's correlated. Everything, all the equities. But yeah, you can say, well, small caps are not outperforming large caps, but you see industries, you try to create a portfolio that's balanced in different industries, and yet, you're seeing the market up 2%, down 3%, and all these things are getting hit around the same. Yeah, you might get retail get hit a little bit more on tariff news, and banks get hit a little bit more when interest rates are lower because their net interest margins are not as wide. That's how they make money. But overall, if you see these, mostly everything's correlated. You're looking at ETFs that are not supposed to have stocks, and they do. They'll have Amazon in it, or oil companies having maybe just different energy companies in there to try to have strong returns. But almost everything is correlated. Bitcoin is not. You can own Bitcoin and make money on it while the rest of the world crashes. Say the same for gold. But that's what makes Bitcoin a really attractive asset. And you can't really say that for gold. Gold prices, not gold stocks. They get hit just like that's not the safe haven. Gold stocks are not the safe haven. You want proof of that? Look at the financial crisis. Every gold stock got destroyed. Gold prices held up, but the stocks got destroyed.